Yeah, so we often get this question, sort of where would the assets sit for the customer, and I think as many for many people, the security of where your assets sit and where they will be held is very important, and then we do have stringent measures in place to prevent an event like a closure happening. But because of our license, we are going to hold your funds in a trust account, DBS, and your investments will be held in a custodial account on Saxo. And the sub-custodians are Citibank and HSBC. So this means that in an event, if Syfe stops operating, that your assets will actually sit separately, right? That it will not be touched. And clients are also, of course, free to withdraw their money at any time, and we do not impose any exit penalties or lock-in periods. So yeah, I think we'd like to go to the next slide just to show the journey of Syfe. So we launched in 2019 in Singapore, and then our client base is here, but the customers come from many different countries. So we have 42 different countries, and going from the youngest is 18 and the oldest is 93. So it's never too late to start investing, even if you're in your retirement years, in your golden years. And more recently, we've launched Syfe Trade, and for that, on the AUM on Syfe Wealth, it's grown a lot, as compared to when we launched. And the last round of fundraising, we fundraised about 52 million USD. Yeah, next slide, please. But this is just sort of one place where you can see all the offerings on Syfe. So today we are going to talk about Cash Plus, which is in the middle of the page. So this is a level 1 risk level. So it means that relative to everything else, this is very safe. There are no lockups, no limits, and no tiers. But we do have other offerings, like if you want to build your core allocation, we have 4 different portfolios, going from the most defensive and the most conservative to something that's more aggressive and more growth oriented. And then going down the list, we have REIT Plus. So REIT Plus is for people who are interested to have an income solution that pays a pretty good yield. So in 2021, the yield was 4.8%, and this tracks the S-REIT Leaders Index. Within REIT Plus, we also have an option where you have REITs with risk management. So it's split between REITs and also the Singapore government bond fund. And next we have themes. So this is something that's really taken off in 2021 and a bit of 2020 as well. So these are thematic investing. You're investing in some of the biggest trends. So in how the world would look like maybe 5 years, 10 years, even longer road. So we have 5 portfolios going into ESG, healthcare, disruptive technology, China, and then global income. And lastly, we have the custom. So this is a portfolio builder for you to do it yourself. If you're interested to pick your own ETFs and put your own portfolio, that's a good place to do that. So this is not managed by Syfe, but completely self-directed. Yeah, if we can go to the next slide, please. Yeah, so this is something that we've wanted to share just to get the ball rolling. So this is what many clients have been thinking about.
Grace, hey, sorry about this. Maybe I'll just share the slides from my end. Melvin is having some trouble. So okay. Let me share the screen from my end and then it should be good. Melvin, if you could stop sharing and I can start. All right, so we should be good now. All right. Yes.
All right, thank you. Yeah, so these are things that are top of mind, right? So we've seen MAS tighten monetary policy last week in rather a surprise move because they made this decision between meetings. And inflation's of course, top of mind. We've seen high inflation both in Singapore in the US. Next slide, we'll talk about that. And yeah, what does this mean, right? And then of course, the market in the last 2 weeks have been difficult to navigate, to say the least. So I think we are trying to address this, all these concerns that clients have in the changes that we've made to the Cash Plus product. Right, next slide, please. Right, so just introduce, what's been happening in the inflation for inflation rates in both US and Singapore. So for Singapore, we see that the core inflation, which is represented by the blue line at 2.1%, but actually if you look at everything, so this is all items inflation, it's coming at 4%. This is considered to be really high for Singapore, but if you look at the US, it's even higher. So if you look at CPI for all items, it's coming in at 7%. So if you exclude food and energy, which tend to be more volatile, it's still pretty high, about 5.5%. So what does this mean, right? This means that for a lot of central banks, their objective is to firstly keep prices stable and to encourage economic growth. Right? So in Singapore, like the Fed, we want to promote sustained and non-inflationary economic growth, as well as a sound and progressive financial service sector. So what happened in the last time that we had an increase in interest rates? So in Singapore, we don't use interest rates like the Fed funds rate in the way that you have in the US. So central banks do tighten monetary policy when an economy is accelerating too quickly. Right? So when inflation overall prices is rising too fast. This happened in 2015 when the Fed funds rate was first raised, which you see on the chart on the right. And because we are more dependent on trade, so MAS tends to use the exchange rate, the effective exchange rate, as the main policy tool. So this Singapore dollar nominal effective exchange rate, which I call the SNEER, it's the exchange rate of the Sing dollar against a trade-weighted basket of currencies of our main trading partners. So to limit, import push inflation, right? Because when prices elsewhere increase, and as we trade with those partners, eventually, the prices that you see in Singapore would also come up. So to limit the impact of that, MAS is opting for a stronger Sing dollar. So in this chart, you see that from roughly 2017 all the way to 2019, just as when the US increased the Fed funds rate, the Sing dollar also follows the appreciation pathway. So when it's going up, it's appreciating. And when it's going down, it's depreciating. So what will happen this year then, right? So since we saw Singapore tighten monetary policy at the meeting, or not at the meeting, but in the decision that was released last week. So Singapore is actually one step ahead of the US in this sense. If you can go to the next slide, please, just want to see, in the changes in the federal funds target rate, as well as what's to come for Sing dollar. Right, so most of the market participants, I think almost all, have priced in the first rate hike in the US in March of this year. And it's still, there is a range of expectations, right, for the whole year. So for the whole year, it could go from, some people are targeting, at least 3 rate hikes, some are going up to 6. So it is like a, spectrum of expectations, but what we do know is that it will be higher than it is now. And because Singapore has followed the same trajectory as the Fed did last time, so we tend to tighten when the Fed tightens too, you would expect to see, a similar upward trajectory for the appreciation of the Sing dollar on the left. If you can go to the next slide, please. Yeah, so what does this mean, looking at, where things are now and where things will be at the end of the year, right? So in Singapore, we would expect the Sing dollar to appreciate relative to where it is now. And this means higher interest rates, but it also means inflation reading coming in closer to long-term average. And in the US, so the Fed funds rate is quoted on a range. So it's, so right now it's 0 to 0.25%. So at the end of 2022, it could be 0.75 to 1%, or even 1% to 1.25%. But we are expecting to see liftoff in March. So that means it's a fast rate hike. And inflation, coming in lower and closer to long-term average, and the target of average 2%. Yeah, so because of all these shifts that are happening in the market, we have made the decision to re-optimize Cash Plus, and so the components that make up Cash Plus. So now to go into those details, I'll pass it on to Ritesh.
Thanks, Trace, and great coverage in terms of what's happening in the broader macro market. And as everyone knows, inflation is at multi-year highs, and to the extent that I think, like Grace, you shared, it is closing in on 7% on an annualized basis, which is unprecedented. And what's even more alarming is the pace at which the inflation is rising. The central bank seems to be a step behind so far. And what was considered as a transitory phase of rising inflation seems to be more permanent. And what that means is essentially for the central banks to control this inflation, they'll need to raise interest rates going forward. And to the extent that now there are predictions of as many as 7 rate hikes in this year. So there's a range, like the consensus is around, I think, 3 rate hikes in this year, but there are also, street estimates that there could be as many as 7 rate hikes. Given where the markets are and given how things can pan out in the coming year, we wanted to make sure that our Cash Plus portfolio can remain resilient through these times and give you the necessary yield without sort of subjecting you to untoward market fluctuations, right? So the 2 main things that went into the re-optimization exercise of Cash Plus portfolio was, number one, to give you a Cash Plus portfolio which truly serves as an alternative to your traditional savings account. And what that means is it gives you a very consistent, regular kind of return profile and has hardly any fluctuations, right? So that's number one. And number 2 is it's actually more resilient to interest rate changes and even credit ratings related impacts. So these are typically 2 things that impact a cash management solution, and I'll talk more about these as we move forward. But just to set the context, these were 2 of the more important aspects that we wanted to control in the Cash Plus portfolio. And what that means is, we've sacrificed a little bit of the returns in exchange of giving you a much more, kind of a stable, consistent Cash Plus portfolio, which you can then truly use as an alternative to savings account, where you're now getting, maybe close to 0%. So let's dive into it, right? So what is our Cash Plus portfolio? What are the key highlights? In terms of the projected yield, it's currently at 1.20%. There's a projected return of the Cash Plus portfolio. It is not a guaranteed return. The reason is simple, because it is composed of money market and short duration funds, and which is basically composed of bonds. And because it's not like a fixed deposit and a savings account, the returns actually might vary a little bit, but because of the way that we have constructed our portfolio and re-optimized the portfolio, the actual returns of our Cash Plus solution will be very close to what is projected over here. In terms of how it works, it has a daily accrual of returns built into the product. What that means is you fund your Cash Plus portfolio, you will see that on a daily basis, whatever coupon accruals are there of the underlying bonds, they will keep adding into your portfolio returns as well. So you will see that embedded within the portfolio, and you will see a consistent growth path for your portfolio as well. In terms of other features, some of the very, I think distinguished features that we have for our cash management solution are things like transfer of funds between portfolios. So you can start, like a lot of people, the way they use our Cash Plus portfolio, there could be 2 or 3 reasons why they want to invest into it. The one simple, straightforward reason is they want to earn more on their, idle cash, because the bank savings rate are close to 0, and keeping money in the bank is like losing money, right? Like in terms of inflation. So a lot of people would want to park their cash with us to get a higher projected sort of return, which is 1.2%. Or people want to dollar cost average on our investment portfolio. So they will first dump all their lump sum investments into our cash plus portfolio. And from there on, they would want to dollar cost average into different investment strategies over time. And the reason, I mean, could be different things for different people. Some people are afraid to put lump sum at one go into the markets. So they want to, make sure they are able to do it in a more systematic manner. There is also a feature of automated recurring transfer. So if you want to design a strategy where every month you want to put, say, $5,000 into an investment portfolio, and you say start off with $50,000 in your cash plus portfolio, it'll automatically transfer that much amount on a monthly basis to your investment portfolio. So the way it works is pretty cool, because the 50,000 that you initially deposit keeps earning you this 1.2% projected return while it waits for its deployment schedule, right? So it is basically making sure that your money is working for every dollar rather than sitting in the bank account doing nothing, kind of a thing. In terms of how it is designed, again, there are no gimmicks associated with it, right? So there is no minimum investment required. There are no limits. There are no tiers. You don't have to satisfy 10 different criteria for you to get 1.2%. It is what it is, no matter whether you invest a few $100s or a few $100,000, right? So it works seamlessly across and for unlimited amounts as well. There is no lock-in as well, right? Like there is no lock-in. You can take your money out any point of time when you want, as you want. One another cool feature, I think this is industry first in Singapore, is the same day withdrawals. This is something that no other platform has done. And we went ahead and we wanted to be at the forefront of innovation. And because of that, what we have done is, if you want to take your money out and you have an urgent need, up to 10,000 Singapore dollar, if you send a withdrawal instruction before 11 a.m. in the morning, then you will get the money by 7 p.m., right? So this is something that we have built in-house for your needs. As well as if you make portfolio transfers, so from Cash Plus to another, investment portfolio, as long as you do it, below, again, the $10,000 limit, it can get it deployed on the same day as well, right? So again, all these efficiencies are built in because we understand that these are key, things that you would want to be optimized, because as an investor, you want to make sure that your money gets invested in the most efficient manner possible. Let's look now into the actual re-optimized portfolio. What does it do? What is it composed of, and what are the projected returns? So the asset allocation is basically divided between two Lion Global funds. So Lion Global is the fund manager that we use. We use two of their funds for the new re-optimized cash plus portfolio, 30% to the money market fund and 70% to enhanced liquidity fund. The money market fund is typically composed of very high quality money market instruments, and these money market instruments typically tend to be commercial bills, deposits with financial institutions, treasury bills, as well as again, very, very high quality assets which basically have very little to no kind of default risk associated with them. Then in terms of getting you a higher yield on your investment, there is an allocation of 70% to enhance liquidity. This is from a categorization standpoint, it comes under the ultra short duration categorization. When I say ultra short duration, it basically means that it invests into, again, very high quality debt instruments. And the credit quality, if you are familiar with how credit ratings and all are done for bonds, anything that is rated A plus, those kind of things are typically, supposed to be very, very low risk in nature, right? Like not risk free, but very low risk in nature. And as you go to like B, triple B, those kind of credit ratings, that's where the risk of the underlying bond going default increases. As well as the average maturity of the bonds underneath the enhanced liquidity fund is around 12 months. So, and I'll cover a little bit more in terms of why these things are important, because, I think I covered earlier as well, when you're investing into any cash management solution, the two things that are of utmost importance is, number one, the interest rate risk that you take, as well as the duration risk, or interest rate risk is the same as duration risk. The second is the credit risk that you take, right? So both these components that we have for the cash plus portfolio make sure that from an interest rate risk standpoint, it is very, very low, as well as from a credit risk standpoint, it is very low as well, right? Because mostly it is composed of money market and even in the ultra short duration kind of exposure, very high quality debt instruments. In terms of projected returns, the gross return of this portfolio is 1.26%. There is a fund level fee of 0.29%. And then as Syfe, I think the key features again is the fact that the fund manager, which is Lion Global, pays us back part of this fund level fee. And those fund level fees that we receive back from the fund manager, which is called trailer fees, we actually pass it on 100% to you as a client. So we don't pocket anything on our side. And also on top of that, there is no Syfe management fee to add as well, right? So we don't charge anything, plus we don't keep any trailer fee that we get from the fund manager too. Why is this important, and why this results in superior performance for your portfolio vis-a-vis if you were to invest into these two funds are actually available through other platforms as well, where you can directly invest into these funds. The two things that distinguish us from the others is, number one, the fact that you are investing into the institutional share class of these funds. And because you're investing into the institutional share class, the fund level fee is much lower than what you will be getting or what you will be charged when you invest into the retail share class of these funds. And the second thing is, as I said, the trailer fee rebates. A lot of platforms don't give you back these trailer fees. They just pocket it and use this as their way of earning from you. In our case, we are 100% transparent. We pass on all of this back to you. And on top of that, we don't charge anything from our side. So it's a 100% kind of free portfolio from Syfe, giving you a projected return of 1.2%. Now, let's dig in a little bit deeper into the two components that really impact the returns of a cash plus portfolio. So number one is interest rates, right? Typically what happens is when you invest into bonds, right? Because at the end of the day, the cash plus portfolio invests into bonds. We are investing into very high quality bonds, but bonds are sensitive to interest rate movement. Why are they sensitive to interest rate movement? When bond prices, they are listed and they are traded on the exchange. I mean, they're not traded on the exchange, they're traded OTC, but these bonds, their prices move according to changes in interest rate. Typically what happens is when interest rates go up, it has an inverse correlation with the bond prices. So the bond prices move down. Now the pace at which the bond prices will move down as interest rates go up will basically be determined based on what is the maturity of the bond. And that in more finance jargon terms is known as duration of the bond. Typically, bonds which are longer term maturity tend to react much more to interest rate movements, right? So if interest rates go up, a longer maturity bond, so if you have two bonds, one maturing in 10 years, another maturing in say 2 years, the 10-year maturing bond will react much more to rising interest rate versus a bond which is 2-year in maturity, right? And the reason again is tied to interest rate and the behavior of the bonds when interest rates rise up. And essentially what I think, instead of going into too technical aspect of it, I think what is more important for you to again take away from this is if the duration of your bonds is higher, you will have a much pronounced negative price impact when interest rates move up, right? So that's the correlation, right? So in the current context, what will happen is as the interest rates are on the uptrend, if the interest rates move up at a fairly fast-paced manner to counter kind of inflation, longer maturing bonds will have a more pronounced effect in terms of their price movements and prices going down compared to shorter duration bonds, right? So that's important to note. Number two is the credit quality. So typically, again, bonds are rated by credit rating agencies such as S&P, Fitch, and others. And these are rated like Moody's as well. And these are rated based on the probability of the bond going default, right? And typically what you will see is like Singapore government is rated AAA because, the idea of Singapore government going bankrupt is very, very far-fetched. It is considered to be like one of the safest places, as well as safe haven as a currency as well. Similarly, US treasuries are supposed to be, AAA rated. As you move down, like when you start investing into corporate bonds or you start investing into small cap companies and their bonds, the risk that you're taking keeps on increasing. So instead of rating being AAA, they will be rated as like B, BBB, or even C and further down. typically, as long as you're investing, there is a distinction between investment grade and, non-investment grade or high yield. So as long as you're investing above BBB rated bonds, you're supposed to be a little bit safer compared to when you invest into high yield bonds, right? And again, these two things then go hand in hand, because ideally what you would want to do is, with a cash plus kind of a portfolio, you want a very stable kind of a return profile. So ideally, if you want to construct a cash plus portfolio which insulates itself in a rising interest rate environment, also it has very high quality bonds underneath, such that there is almost no to very low probability of any bond going in default, then basically you need to focus on the portfolio being very low duration in nature or maturing in fairly short duration in time, as well as from a credit quality standpoint, it needs to invest into A rated or above kind of bond profiles, right? So these are the two main things that you need to optimize for, right? And just highlighting this a little bit more from the standpoint of what these different instruments are and how does these different risks play into the portfolio construction process. So as I covered earlier, money market is basically high quality short-term instruments. So the idea here is the duration risk is very low, because in terms of maturity, they typically mature like every 3 months. Like these bonds mature every 3 months to every 6 months. So the interest rate risk is very, very low for these kind of products. The credit risk, again, because they are high quality, short term.
Looks like we lost Ritesh for a bit.
Hey, sorry, Melvin, were you saying something?
Yeah, we lost you for a bit.
Oh, sorry. What did we miss?
I think you can restart this slide, actually.
All right. Okay, so I was saying that essentially when you're trying to construct a portfolio, you can categorize them into 3 buckets. Like a cash plus portfolio, when you try to construct that, typically a cash management solution is built using money market, ultra short duration, and short duration bond funds. And the idea is, like, for these 3 components, there are different metrics that you need to worry about or incorporate in terms of constructing your portfolio. For money market, because it is mainly high quality, short-term money market instruments, the maturity of these are 3 to 6 months. So interest rate risk is very, very low, or duration risk is very, very low. The credit risk is also very low because you're typically investing into treasuries or very high quality instruments. But because these two are very low risk in nature, the returns are also fairly low for money market instruments. Now, the second bucket is the enhanced liquidity. So it will more so, cater to ultra short duration kind of bond exposure, right? So these are, again, still very high quality in nature. The duration risk is a little bit higher compared to the money market instrument. So instead of 3 to 6 months of maturity, here you're looking at 6 to 12 months of maturing bonds, right? In terms of credit risk, I think, again, not the same quality as money market, but it's very similar. It's like minutely different. So instead of maybe A rated as an average of your money market instruments, this will be like A minus or something. So still in the A category is where ultra short duration bonds will kind of feature. From a return standpoint, they have higher return compared to the money market instruments. And the last component is the short duration. So these are basically still investment grade, but now you're taking a little bit of a risk with your portfolio because you're adding bonds which are, from a credit rating standpoint, just above investment grade. So an average credit rating of around BBB. And even the maturity of these bonds tends to be around a 2 to 2.5 year mark. So you're taking a little bit of interest rate risk, and you're also taking a little bit of credit risk. And because you're taking these extra risks, they kind of should translate into higher returns as well, right, in the long term. Now, again, going back to where we are in the interest rate cycle, we all know that the interest rates are on the uptrend. And if interest rates are on the uptrend, the most impacted portion of a cash management solution will be a short duration exposure that you have within your cash management portfolio. And the reason is simple. It has got the BBB rating. From a credit rating standpoint, it's lower in nature. Also from a duration standpoint, it's 2.3 years, right? So it will be more reactive to interest rate changes compared to the other two buckets that we talk about. Now, taking into consideration where the market is headed, what we have done is this, right? So the old cash plus allocation was basically split between money market, short duration, and ultra short duration as well, right? So money market, enhanced liquidity, and short duration, approximately evenly across the three buckets. Now, the new re-optimized cash plus portfolio actually removes the short duration bond exposure altogether and puts that exposure into the enhanced liquidity bucket, right? And doing so, what it does is basically removes a lot of your interest rate exposure and positions it such that it can navigate through the current, interest rate hiking cycle in a much more effective and, steady manner as well. Of course, what it also means is because we are, reallocating this 35% to the enhanced liquidity bucket, the projected return of the portfolio goes down from the old cash plus, which was giving around 1.5%, to the new cash plus portfolio, where the projected returns are now 1.2%, right? But let's look at this in a bit more detail, right? Like, how do we compare the two different portfolios in terms of overall characteristics, right? So returns, of course, the return goes down from 1.5% to 1.2% in the new cash plus portfolio. But I think the bigger thing that you need to note is the risk of your portfolio also significantly goes down. And this is basically demonstrated by, number one, if you look at the portfolio characteristics, the duration, which again is a measure of interest rate risk, the average or the overall duration of the older cash plus portfolio was around 1.25 years versus the new re-optimized cash plus, the duration is 0.73 years. So roughly around 7 to 8 months. So on average, every bond in the portfolio matures every 6 to 7 months. Also, the credit rating of the underlying funds, if you see, the older one was A, and BBB because of the short duration. And in the new allocation, because we have removed short duration, it's basically all AA, right? So in both these metrics, the newer cash plus portfolio is a much more safer portfolio compared to what the original portfolio used to be. Now, of course, the original portfolio was also designed to give you the long-term, higher return per se. But again, I mean, like, we have to put into context where we are in the interest rate cycle and what is prudent as your fund manager for us to do to make sure that you can navigate through the current situation in a much more effective manner. And that's where the new optimization exercise makes sure that your interest rate risk is minimized as well as your credit risk is minimized. Also, from a risk metric standpoint, if you look at things like drawdown risk, the old cash plus portfolio was down 0.75%. So that's kind of the max that it went down. In context of a cash plus solution, actually, it's pretty low, right? Like, even the previous allocation, if you had $100, even in a pandemic time like 2020 and all, the portfolio would have experienced a drawdown of 0.75%, right? So basically meaning it would have gone from 100 to 99.25. And just to give you some context, during the 2020 pandemic, the equity market dropped by 35%. So again, it was very low in terms of drawdowns. But the new optimized cash plus portfolio is even more safer. It is safer to the extent that it actually almost has minimal drawdowns. So it will give you the feeling that your portfolio is very, very smooth and it will not react much to the overall, market sentiments and all. And this is what a true cash management solution ideally should look like as well, because it becomes a little overwhelming and daunting when the markets are going down, all your investment portfolios are going down, and you observe that your even cash portfolio is going down. Like, it becomes a little hard for you to stomach. And even though the amount by which the cash portfolio is going down is very, very tiny, just the fact that it is going down can be unnerving. And we've taken that feedback from all our clients to make sure that the new re-optimized cash plus portfolio actually has minimal to no drawdown periods. And again, this can be highlighted into the next row. The number of negative days of the previous cash plus portfolio, this is over a 3-4 year kind of period, was 173 days versus the number of negative days in the re-optimized cash plus portfolio over a course of 3.5 years is just 35 days, right? So very, very smooth and steady. Also some features, right? Like, because the short duration portion of the older cash plus portfolio had a longer settlement cycle, it used to take 3 to 4 working days for you to receive back money when you pressed on the withdrawal button. Because of the enhancement that we have done and removal of short duration bond portfolio, the new timeline for you to expect funds back to your accounts, and this is for larger amounts, like, if you're investing and withdrawing, say, $20,000, $30,000, you can expect to get it back within 2 to 3 working days. Now, on top of this, the same day quick withdrawals and transfers has been enabled. I talked about this feature earlier as well. Up to $10,000 if you withdraw and send the withdrawal instruction before 11 a.m. on a given day, you can expect the money to hit your bank account by 7 p.m. on the same day. Similarly, if you're making internal transfer up to $10,000 to other investment portfolios, that will also be done on the same day if you do that transfer instruction before 11 a.m. All right, so this is a little bit more of a graphical and visual representation of how the older cash management or the cash plus portfolio looked like, right? And what you'll observe is the 3 underlying components of the cash plus portfolio. So you had the money market bond fund. So you see like a very smooth straight line, but the overall return is the lowest, right? Then you have the enhanced liquidity, which is the red line. So a little bit higher compared to the money market, but again, very smooth and very straight, right? So there is no volatility or almost minimal volatility for the enhanced liquidity fund as well. And then we had the short duration sort of exposure, which was your golden line. And what you notice here is like, the short duration portion of the portfolio is what contributed to the volatility in our cash management solution, right? So you see that the portfolio or this, short duration fund has episodes of going up and down, right? So it will potentially have periods of outperformance, like you see in the period of like August, September, but it'll also react to market incidents, right? There was the Huarong Chinese bond market incident in early April last year, as well as there was a Evergrande contagion kind of an impact during the later half of last year. And both of these led to quite a bit of sell-off in the Chinese bond market. And the short duration portion of the portfolio does have some exposure to these sort of names because it takes more risk in the portfolio. And because of that, it went through a lot of ups and downs during these periods. And if you see the green line, that's our cash plus portfolio, right? And again, it did overall okay and better than both the enhanced liquidity as well as cash plus portfolio, the money market fund, but it went through some periods of ups and downs as well, not to the same extent as the short duration, because short duration was only 35% of the allocation, but it still went through these ups and downs to some extent. And that again, like, was not that well taken by a lot of investors who, tend to be a little bit more more concerned when a cash solution like this has movements associated and all. There are, of course, investors who don't mind it because in the longer term, it will also result in higher returns because of the short duration exposure. You see this period of outperformance. You can expect these periods of outperformance to potentially come in, in periods going forward as well. But again, as a cash solution, do you want your cash to have these movements? The question and the answer mostly is, no, I don't want such movements in our portfolio. In my cash portfolio, I want it to be much more stable. So what that means is this, right? So we have re-optimized the cash plus portfolio, and the orange line is what the new cash plus portfolio will look like, right? In terms of how the portfolio moves over time versus the original cash plus, which again, is hovering around this same orange line as well. But as you can see, there are periods where the original cash plus portfolio overperforms, and there are periods like Huarong incident and Evergrande contagion where the portfolio underperforms as well. And given where we are in the interest rate cycle, again, because the older cash management solution had the short duration portfolio attached to it as well, it would potentially be more riskier to hold that portfolio from a look forward standpoint too. And that's where the re-optimization actually makes it a lot easier and a lot smoother for you as an investor to have a consistent growth profile without being impacted by the rising interest rate, right? And again, just to highlight this in a more optical manner, you look at the Cash Plus re-optimized portfolio, the monthly returns of it, it's very consistent, no negative months at all, versus the older Cash Plus portfolio. There were periods where it did much better than the current new Cash Plus portfolio, like in June, 0.12% to 0.18%. So there would be periods like this, August, 0.24%. But there'll also be periods of these negative returns, minus 0.05% in April and October as well, right? The full year return of the new portfolio is actually higher for last year, mainly because of these two episodes which eroded the returns of the older cash management solution. And again, we are of the view that going forward, as the interest rates are increasing, the new Cash Plus portfolio will give you a much more smoother ride, and you will have a consistent kind of growth profile going forward as well. So typically, if you're expecting the forward-looking projections to be 1.2%, you can expect somewhere close to 0.1% accruing on a monthly basis into your Cash Plus portfolio. All right, so again, reiterating some of these points, our new Cash Plus portfolio is really positioned for rising rates. Also, I think just to highlight, because the portfolio inherently has shorter maturity, what that also means is as the bonds in the portfolio keep on maturing, they'll mature at a much faster rate, right? Like every 6 months, these bonds are maturing. And as interest rates move up, these bonds, as they mature, the money will need to be redeployed into the market. And what that means is because most of these bonds are held till maturity, you will enjoy that steady growth in the 6 months to come. And as the bonds mature and they're redeployed in the market, and if the interest rates have gone up, then you will automatically invest into higher yielding bonds going forward as well, right? So again, it will give you a much smoother ride against the rising interest rate environment. So that's number one. Number two, it has both low duration risk as well as low credit risk compared to the previous Cash Plus portfolio. Overall, it's got a much more stable NAV because both, if you go back to the slides that we talked about, both the enhanced liquidity and the money market funds that we have in the current new Cash Plus portfolio, both have a very steady profile built into them. And what that means is you will enjoy a much steady growth path onto your Cash Plus portfolio. It will give you a much smoother return journey. And overall, you don't need to worry too much of, whether it is from an investment interest rate risk standpoint or credit risk standpoint. Also, as I mentioned earlier, compare it with any other typical instrument that you have where you hold cash, right? Like savings bank account and fixed deposits and other such things. There are typically a lot of gimmicks associated with them. We don't have any lock-ins. There is no management fee. You can withdraw your money at any point of time, and it is for any amount of money that you want to put in, right? So, these are the key features of our new Cash Plus portfolio. Just reiterating things in terms of, where does the cash management or the Cash Plus portfolio sit vis-a-vis your traditional cash solutions. So whether it is the fixed deposits, the SORA index, which is more like the newer equivalent of SIBOR or the 3-month interest rates in the market. So something close to those aspects. So again, less than 1%. Singapore savings bonds, a lot of people invest into Singapore savings bonds for their cash as well. And again, both, if you look at the current rate as well as after 3 years of issue, they still are lesser than the projected returns of our cash management solution. You can invest into the Singapore government bond, the 10-year, but again, we talked about interest rate risk, right? Like the 10-year treasury, which is the Singapore government bond, will have a much bigger impact of rising interest rate compared to our solution. So you can invest into them, but you will again have a more volatile period of returns associated with it. So considering all of these points and all, and if you compare our Cash Plus with a Singapore bank account, then the return difference is just enormous. Also, just comparing it with some other cash management solutions that are available in the market, you will realize that for the risk that you're taking, for the way the portfolio has been constructed, We have ensured that you're invested in a portfolio that can give you a very steady return profile without exposing you to unnecessary risk. And a lot of other cash management solutions out there in the market, you might see higher projected returns, but please bear in mind that higher returns doesn't come free. They come with associated risk. And what that means is you can experience a much more pronounced, volatility with those kind of portfolios, like what you see in this gray line, versus our cash management solution, which will give you a very steady kind of a return profile, as you see with the orange line. All right, so again, reiterating how the cash plus portfolio looks like compared to a typical bank savings account, and features that we've already talked about. In terms of the portfolio and the platform itself, it's very easy for you to start yourself up and start using our platform. You can onboard yourself using MyInfo, go to our website, or download our app using Google Play Store or Apple App Store, and you can get started instantaneously. The fees, we were concentrating today on the cash plus portfolio, but there are, of course, all the other portfolios that Grace also talked about. And the fees keeps coming down the more you invest with our platform. There is no minimum for you to get started, so you can start with any amount. But as you invest more, the fees keeps coming down. Of course, the cash plus portfolio itself is zero fee, so there is no management fee associated with the cash plus portfolio. If you are starting today, if you want to invest into our investment portfolio, so any of these core REIT themes and custom portfolios, then you can get up to 6 months of your money managed for free. Of course, the cash plus portfolio again is a free portfolio, so there is no fee waiver applicable to the cash plus portfolio itself. But if you want to invest into any other portfolio, you can get 6 months fee waiver for up to 50,000 if you use this code, which is Syfe Waiver. Also highlighting a few upcoming webinars. So there's a very strong lineup of webinars coming in for the month of February. Do tune in into them. I think they're very relevant considering where we are in the market cycle. The markets are very volatile. We saw, yesterday, the NASDAQ post-close earnings announcements for some top companies like Facebook, as well as PayPal and all. And that has had some impact in terms of, how the markets are looking in terms of, moving ahead. Plus, again, concerns around interest rate movements, concerns, on the continued COVID-related aspects as well. We have these webinars to help you think through a little bit better in terms of how to position your portfolio moving forward. So we have the Market Outlook webinar coming in next week. We have a specific webinar coming for hedging your portfolio against inflation. That's on 17th of Feb. Then we have a dedicated webinar for metaverse. So this is a trending topic right now. A lot of people are interested in Web 3.0 and metaverse, and what does that mean in terms of future investment opportunities. So we'll cover that into this Market Spotlight event. That's on 24th of Feb. And then we will cover a little bit more on real estate as an asset class and how you can implement it using, say, our REITs portfolio, right? So that's on 3rd of March as well. Last but not the least, we have a very seasoned investment advisory team as well. So please feel free to reach out to our advisory team. I know this session might not be enough to cover every portfolio of ours in detail. So if you want to share your specific situation and understand our portfolios and investment strategies a bit better, please feel free to reach out to our team of wealth expert, and Melvin is there with us today. So, you can go onto our website and schedule a free consultation with us anytime. All right, so let's open it up to Q&A. Melvin, I will just leave the slide here, and yes, let's take some questions.
Thank you so much, Ritesh. So actually, there was a interesting question. So I think some of the investors out there might be thinking that there's a time duration to this cash plus portfolio. So is there any timeline before the plan matures and clients no longer have access to it to be forcibly liquidated?
Right, so as I covered earlier, this is a portfolio where there is no kind of like a maturity thing, right? Like you don't need, your money is not locked in. Your money is available 24/7, so you can withdraw your money any point of time. In terms of how this works, because it is invested into liquid money market and ultra short duration bond underliers, typically it will have some variation in terms of returns, right? So we covered that a little bit here in terms of the monthly returns. So you see, there is just positive returns on a month-to-month basis, right? So the re-optimized Cash Plus keeps giving you a steady return profile. You see the orange line as well. And what that means is you will enjoy this as you go, right? So whether you invest for like say 15 days, you invest for 2 months, whether you invest for 6 months, then essentially the returns will also prorate accordingly, right? Like if you invest for say just the month of Jan, you would have invested and gotten 0.16%. If you annualize this 0.16%, it will come, north of 1.2%, because the base rate for you to get to 1.2% is roughly around 0.1%. So, and you see like on a monthly basis, the portfolio keeps hovering between 0.1%. The lowest return that it gave was 0.08%, right? So there could be some months where it can give you slightly lower than the projected return, but for most of the months, it will remain very close or above, the 0.1% number.
Great. Thank you so much, Ritesh. So some investors have been seeing this rebate value inside their portfolio. Could you perhaps like clarify a bit on that?
Yeah, so I think this is right. So this is the part, right? Like, we give the rebates that we receive from the fund manager, right? As I pointed out, we invest into these two funds, money market and enhanced liquidity. The fund charges 0.29%. So this is the expense ratio of the fund. And this is kind of embedded within the NAV of the fund, right? So typically, this is, if you were to just invest into them on a direct basis, you will see 1.26% minus 0.29%. Now, what we do, or we enable for clients, is the fund manager, because we are helping distribute their products through our portfolio, they give us a rebate back from this fund management fee, right? And what we do is we pass on those rebates back to you as a client. Now we do this on a quarterly basis, but we keep an account of it on a daily basis as well. So if you withdraw within 15 days or 1 month, we will calculate what is the prorated amount of trailer fee that is applicable to you, and we will front that trailer fee for you to take back as well. But in the app, I think I'm not mistaken, it updates on a monthly basis. Melvin, I'm not sure if it is monthly, but I think you can continuously see what is your accrued rebate, but we update the exact amount on a monthly basis is what I remember last.
I believe it's on a monthly basis as well. So perhaps another question, one that comes in during my conversations with clients. So with the reduced volatility expected for this portfolio, for the other cash component inside our investment portfolios, will they be, shifted inside this Cash Plus portfolio? Is there a possibility?
Yeah, I think that's a good question, and potentially something that we should look at in the future, because I understand that in our investment portfolio, usually there is like a 1% or more cash buffer that we keep to keep it like, a little bit more efficient in nature, because the reason we keep those cash components is either to make sure that we have sufficient buffer when there are new buy orders and all, and we don't want to overbuy or oversell. Plus, we charge management fee using that cash component of the client portfolios. Plus, there are things like dividends and all that need to be paid out for certain REIT portfolios. So again, like these are small different reasons why we keep a very small amount. And again, usually the amount is like less than 1%. Yes, I mean, it will be nice for that 1% to also earn some interest, right? The challenge really is the fact that these are actually instruments themselves, and if you invest that cash portion into them, the efficiency that we are trying to build into those portfolios with respect to managing the cash component will be lost to a certain extent, because you will need to, each time you need cash to optimize the portfolio or do any transaction with respect to the portfolio, you will need to first liquidate this cash management or the cash portfolio for you to enable that part, right? Like, so enable those transactions. So that's where there are those, things to potentially fix before we can enable these optimizations on the investment portfolio side, the cash component. But again, like, in terms of drag, I don't think it has a meaningful drag on the investment portfolios. It's typically less than 1%. And we are, by the way, taking some steps to further improve the cash holdings of our investment portfolio. So in the near future, you can expect the cash components to further come down.
Great, thank you so much. So maybe another one is there like a recommended holding period or investment period for this portfolio?
Right, so that's a good question. So this particular portfolio, as I said, has had almost no negative months at all, right? So if you look at the past returns, it's a very steady portfolio, no negative months. The only period that it had like a slight negative performance was, 2020 period. And even during that time, it was, like 5 basis point, right? Like, so essentially if you have $100, it would have become 99.95, right? Like, so that is the extent that it might have gone down. But what I have seen in terms of the results, when I saw the historical parts and all, I saw, very rare periods of even weekly negative returns, right? So this is monthly returns. So even weekly perspective, I saw very few weekly negative returns. So I would say that as long as you are able to hold this portfolio for at least a month or more, you should expect positive returns from this portfolio.
Right. And for investors that are, that are fine with taking on the interest rate risk, do you think there'll be an option whereby, they will get to select the short duration bond fund back into the portfolio?
That's again a very good question. So this is something that we will be researching more on. And again, we just wanted to make sure that our current cash portfolio, because it's just one portfolio solution right now, it is positioned to navigate through the current interest rate environment in a much more stable manner, as well as like the episodes that we saw in the last year with Evergrande and Huarong. We don't want similar situations to sort of have any negative impact to our cash management solution as well. And to that extent, the decision that has been taken in terms of the re-optimization exercise, we are sacrificing a very tiny amount of return with the view that it will give you a much more stable kind of return profile with minimal volatility. So that's, I think, the thing that we wanted to prioritize first. As a cash solution, the number one thing that we want to do is steady returns and minimal volatility. So, that's what this portfolio achieves. In the future, and this is where like Grace will potentially also put in some effort to think through if we want to develop a kind of a portfolio which can give people higher return profile by taking either interest rate risk or credit risk as well, right? So those components we can look at in the future.
Okay, perhaps another question is, if we rebate the trailer fees, what does Syfe actually earn from this investment?
Nothing. We don't earn anything from this. Absolutely free. As I said, there is no gimmicks attached to it and all. Look, I mean, like the reason or the view that we have is a lot of people actually have spare cash sitting in their bank accounts doing nothing. And what we want to do is ultimately our goal is for people to invest as much as possible, because even a cash management solution giving you 1.2% long-term will not beat inflation. So it is actually still better than money sitting in the bank. So our hope is that investors sitting on the sidelines doing nothing with their monies at least will start moving money into this cash management solution, get themselves familiar with the investing world, get more confident about investing into more riskier portfolios with the view that they can actually beat inflation using them, right? So we do earn something on our investment portfolios. And again, like the view is at the end of the day, if you're just managing your cash with us, just from the standpoint of temporary cash management kind of a solution, it's great. It will do that job for you. But we as individuals all have a lot of money which is just sitting idle. And if that money is not your emergency fund, all of us have goals. If we don't invest that money, it'll be very hard for us to achieve those goals, right? So again, I mean, like, you know, it's basically this whole education process that goes on with this cash solution as well. So yeah, I mean, we are just basically a little bit long-term greedy as well, that, you know, our investors grow, they invest, and we grow as well.
Perhaps one last question for Grace. So someone's wondering, with the projected interest rate increase in the coming months, how do you see this impacting the return rate for the cash plus?
I mean, that's exactly, you know, what we're trying to get at with the new versus the old, right? So we will expect to see higher projected returns, right? So effectively, what happens is that let's say you have a bond that's maturing in 3 months' time, right? So at the end of May, for instance, right, then the rate that they borrow at, so, you know, in a way, your coupon rate would also be higher. So that generates a higher income return for the person holding it. And we've seen this sort of projection being introduced, or, you know, being incorporated in some of our peers, and when they do projected yields, they are incorporating that. But so far, for the 1.2% that we are projecting for the return, we have not included that yet. Right, so we're taking a more conservative approach, thinking of, you know, if we don't see like the most sort of hawkish outcome, you know, with what's going to happen this year, this is what you would expect to get, right? So, but of course, if we do see, you know, more rate hikes and the cost of borrowing go up, we would also expect to see higher income return.
Yeah, and we will, you know, update these returns on a regular basis. Usually there is a quarterly update, but if the projected returns increase significantly, we will update, you know, on a more proactive basis as well.
All right. I believe that's all the time that we have for this evening. Thank you everybody. So if there's any other questions, do write into us. I believe we can be reached at support@syfe.com for any technical issues, or for clients, you guys can use the app to reach out to us advisors.
All right. Thanks, everyone. Have a good evening.
Bye.
Bye.